No, I would just, it's just frightening, that's all. Yeah, I would imagine they'd have to open up quite a big facility to just basically liquefy all these guys. And that's the only move that would really please Wall Street. Yeah, heaven help us, I guess. I don't think the Fed should intervene unless it's an emergency. But, the question is, when do you make that call? Is it one day could make a big difference? I'm not sure they should open bank stocks on Monday. Unless there's like a serious TARP in place or something like that, because ultimately none of these loans are liquid, right? Yeah, no, you could have real collateral impact, but to me, it's just so funny how the mismatch of the balance sheets are, right? You have these mortgage loans that are, the theory is that you should never have a depositor base that could actually act en masse, right? But now the world is so much more connected with Twitter, and it just takes one idiot to start tweeting like a moron and saying, oh, is there needs to be a fundamental rethinking of you have this place that requires instant liquidity for your deposits, but then they're making 30-year home loans with most of the money, and it's 20x levered, and by the way, the moral hazard is you're not getting any of that upside of those loans. You're just feed for the cattle or whatever, and something goes wrong, there goes your money. But to me, that's the problem. It's on the balance sheet, right? So I'm assuming the stuff in the balance sheet is their it's their loan, right? I would imagine the MBS desk at Goldman or JP Morgan or whatever, they're traders too. So at the wrong prices, if they see a flood of these, right, they're going to say, wait a second, I'm bidding 95 cents now, or 90 or 85. No, I think that's the move. And somebody was making fun of it, but the French Bulldog software as a service company for French Bulldog lattes or something, is not going to make it. But the real SaaS companies that, are in trouble, or the real biotechs that are in trouble. The problem with biotech is, right, there's no asset back, right? Whereas a SaaS company is, a little more serious, but a biotech that has 50 million that needs to make payroll, maybe a short-term loan would work, but I think you're definitely going to see the private capital space step up. And the other question is what will the Feds let people do? Because there's foreign, not just Canada, but there's tons of other places that want to deploy capital. But I just don't know that when I look at these balance sheets, it's all home loans, right, which are good assets, but they're liquid and they're definitely sensitive to runs, right?
So yeah, a lot of chat about what's safe, what isn't. It's funny that treasury bonds can be unsafe if you have liquidity needs. So, what's safe is a function not just of the safety of that asset, but also the liquidity of that asset. So there's no obvious sort of answer for a lot of these things. Yeah, there's no safety is always relative, right? You can always have your money taken away by the government or the state, as we sometimes call it, disparagingly. The CBDC slave coin is coming. I think the conspiracy theories are a little silly. I don't have any predictions for tomorrow. The stochasticity is significant. Entropy is rising. Be afraid. But I think there's this I want to say there's an 𝗟𝗏𝗚𝗧, or an anchoring central tendency towards chaos. It's hard to know exactly what'll happen today, tomorrow, etc. You can look at it a lot of different ways, and I don't know that there's an obvious prediction as to what'll happen. Like I said, the stochasticity is significant. You have a lot of nodes in this decision tree, and a lot of them are nodes you can't see. It's a hidden Markov process. I don't know I don't look at bank stocks, so I don't know. I think the valuable kind of perspective here is a bank analyst, but to me, interest rates are hedgeable, 1. 2, you have duration. There's a lot of duration hedging that happens. So 𝗕𝗢𝗄 said that Interactive Brokers doesn't buy higher yield long-term bonds for this exact reason. The duration risk isn't worth it. Yeah, so in terms of will we see a big deleveraging process where there's this contagion of fear that feeds on itself and et cetera, it's possible, but it's also possible we go back to normal, right? And there's no real way to predict this. It's way too, you may predict it correctly by accident. You may predict it correctly and assign some wisdom to yourself when you should be assigning randomness. So bonds are fixed income because the coupon is fixed. We don't know if this is 2008 2.0, so
We don't know if this will be blown over within a week, or we don't know if it's the beginning of the end, right? We have no clue. 2008 was very interesting. Worry is a relative statement, right? Markets react instantaneously to new information. So it's very hard to sort of think about things in terms of worry, right? It's just is what it is, you know? You have to react to the prices. So there's like two ways to philosophize about it. The market's going your direction, you're happy. The market's not going your direction, you're sad. That's kind of not a great way to look at it, I think. Even though your mind wants you to think that way, right? Your mind really would prefer that narrative, and you have to kind of fight that narrative. In terms of Cramer, I think, yeah, the guy he's a good dude. He has to talk about things all day long, which leads to this kind of sort of difficult situation where you're on tape all the time. If you or I were on tape all the time, it could be very easy to put your foot in your mouth. It wouldn't be hard at all. It's either that or you hedge everything kind of like I do. You're careful and intelligent about and measured about what you say. That's very boring. So that's not good for television. So it's a really hard job he has to sort of make everyone happy, and I don't envy his job with that. What should we be anticipating when the markets open tomorrow? I mean, I think rationality. Ultimately, the real move was to buy Silicon Valley Bank puts during the chaos. That was the real move, that a calm, rational person would have said, there's a good chance that this gets bad. Can I buy, it's sometimes called punts on Wall Street, can I buy these punts, get a 100x or something like that? And I think that, most of us missed that trade, obviously, right? And I think it is what it is. But that was probably the best trade to make, just on the risk-reward basis, right? 𝗕𝗢𝗢𝗔𝗟. Yeah, so in terms of what will happen next, nobody knows. You have butterfly effect, chaos theory type dynamics at play. The Fed is a node in this. Entrepreneurs are a node in this. In the long run, decentralized money is kind of a node in this, right? And Bitcoin was sort of created in response to events like this, right? So I think government intervention is bullish in the short term, but bearish in the medium and long term. Nobody knows. If you can't pin, one trader in New York can decide to sort of bail or press a short or whatever, and the other traders' reactions are very hard to determine. It's kind of like the three-body problem. This is very, very, very stochastic. There's just no obvious way. If you think you can predict mass psychological movements, maybe with better than 50% accuracy, then you have, maybe a chance to win in this kind of a trading environment, but this is not easy. Venture debt is not a good idea for banks to give out, and Silicon Valley liked to do that quite a bit. There is some question about beta, like if you think about high beta, is there like some obvious reaction there that, do you want to own high beta? Or you obviously don't want to own high beta. I don't know if that's the right mentality either. I almost wonder if and this sounds really strange, that tech could actually become more of a safe haven than not, especially the tech haves versus the tech have-nots. You kind of would think that startup disruption is kind of positive for a Microsoft or an Apple. And then you would also sort of think that there's honestly, a question about is this bullish for the other banks? As weird as that sounds. I don't think there's a bailout, but I don't know. There could still be a bailout for sure. Well, what can we do? I think this FHLB could be used to liquefy the banks. So they basically have to let the FHLB window open for a huge amount, which basically is nationalizing the home loan business, which we've already done in this country a couple times. So it's a complicated picture, that's for sure. Here's what I'll say. I think that if you look at the problem with banks fundamentally is that no bank is impervious to a run, right? That's the whole point of a fractional bank or the fractional system, is that they don't have enough cash for, let's say, look at this company. They have 88 billion in deposits. This is Signature Bank based in New York. They have $6 billion right now. So if 10% of their customers want their money back, they don't have the cash for that. They have enough cash for 7% of the people who have deposits with them. And I think a lot more than 7% are worried about the solvency of the bank. Now they can do this, they can go to this available for sale and sell that off, which is just pretty nice. So now they've got 24 billion, which is 28%. This held to maturity, they could certainly bail on some of that as well. So that would be like more in an emergency, maybe they could sell that. That's already marked down, most likely, but they could sell another $5 billion of that. So theoretically, let's sort of look at that other kind of like run scenario. This is all useful. This is probably not as useful. This is probably useful. This is pretty deep discount. This is not a deep discount. So this is at least like the somewhat liquid stuff. I don't know how this FHLB works, if they can really tap, how much they can tap. This bank actually looks a little more liquid, quite frankly, than the others. First Republic looks uglier than this one, but you could still see a deposit run. These guys have reports too. So the FHLB book is 115 billion. So does that make sense to you? That Signature is 10% of the FHLB book? Is this just New York? Or yeah, this might be just New York. Okay, so they have $1 trillion in advances. This is the FHLB. So the mortgage market's around 12 trillion. They have $1 trillion out there. So they'd have to expand their balance sheet quite a bit. I think that the fundamental problem is the liquidity mismatch and the smaller banks just sort of having a, I guess vulnerability, maybe the best way to put it. It's a pretty profitable entity, I have to say. Well, I don't know much about this entity. Is the FHLB a private company? Is it held by member banks? Is it top 10 regulatory capital stockholders? So I don't think the banks can bail out the banks. That doesn't make a lot of sense, does it? That'd be a little odd. To me, it's very odd that you can grab an FHLB loan to liquefy your book, because ultimately the banks that can lend you the money are still they still have mostly the same loans in their balance sheet. And there's normally nothing wrong with these loans. Mortgages are good loans, but if everyone wants their money back, that they're not so great, right? FHLB seems to be owned by a bunch of regionals. It says that PNC is the largest stockholder of. I do think everything will be okay. I hope everything will be okay. SBNY looks somewhat solid. I mean, it's kind of scary that they have they're 1% of the FHLB book. So they owe, basically these liabilities aren't going to change. And maybe, they basically have 30 billion in liquidity and 100 billion in deposit/debt. Doesn't seem as bad. 8 billion in equity. I think this is all a question of confidence, right? They're going to take the money and put it into JP Morgan, basically. And the big will get bigger and the moral hazard will continue. And basically that'll be that. In general, I think the Fed should probably come up with some way to boost confidence in banks. A lot of banks, by their nature, are susceptible to runs. So liquefying home loans or other ways to increase confidence in these smaller regional banks, they're really not run proof. I mean, that's the problem. No bank is truly run proof no bank will ever be run proof. And maybe that's the lesson in all this, is that no matter what we do, banks will never be fully run proof, and that there should be some way to make these banks a little bit more robust. Maybe they should be lending less, the balance sheet should be smaller. There's a lot of sort of questions as to what, the right way to do this looks. I feel like, you're going to continue to see this stuff, a very small misstep, plus this connected contagion and fear that we all have, thanks to this sort of like very networked world we live in, can create these panics. And when you throw Wall Street into the mix with things like 0-day put options and stuff like that, it can be really dangerous.